Now we're going to look a bit further into the global supply chain. What are some of the impacts to the U.S. and where do we see prices in general? Because there's a lot of some of the new data sets when we look at cars and what are some of the implications to that. And we wanted to kick it off with where we left off the previous segment, discussing national single-family rent index. So when you look at the year-over-year percent change by price tier, you can see that all of them are essentially either at or above where we were in 2006. And this is that replacement value that we keep talking about, where low-end rental prices were up 4.6% compared to high-end price gains of 7.9%. So this is that inflationary side that remains sticky, because this is an increase that's going to last for whether you sign a 1-year lease, a 2-year lease. These are going to be those residual price increases that we continue to see over that period that's going to replace car prices and durable good prices. And this makes up 42% of the CPI calculation. So this is where we continue to see some of those pressure points. But on the other side, when you look at inventory levels and just where we see things on the inventory side and just what people are buying, because remember, wages are down 2%, prices are up 6%. So you're seeing a broad, essentially, difference between the two as Evercore ISI company surveys, just on the inventory levels are about, just how too low. When we look at too low, it's at 52%. So 52% are saying that it's too low and the pressure mounts, which is why they believe they have pricing power. And you're seeing this pricing power coming through with 45.3% of those that are talked about are increasing the amount of pricing power that is available. And you can see going well above 2006 levels. And all the reason why is the suppliers' delivery times. Like when you look at supplier delivery times, they continue to worsen. Now, we've talked about it. It's flatlining, but it's not getting better. And we're seeing those CPI levels getting pulled up. So here you can see just PMI supplier delivery times at these all-time worst levels, or I should say going back to the 80s is when the last time we saw something like this. But realistically, it's near all-time highs, or if not all-time highs, which is going to continue to pull those CPI calculations up. With global output and supplier delivery times, here's where you can see the longer delivery times continue to get worse globally. So it's not just a U.S. issue. It's not just a U.S. issue or China issue, but it is an issue on a global level. So when you look at manufacturing in general, the output is coming under pressure because there's so much backlog. There's so many issues in terms of getting semi-finished goods that are required for assembly or just raw materials to create that level, which again is keeping some of these stresses in the system, making it less and less transitory the longer it goes on. But then when we look at U.S. vehicle prices have come down. Now, obviously zooming out, you can see that they're just off these insane prices, but are still elevated in regards to the last 21 years. So continuing to see significant cooling on used vehicle value index, now at 24.6% year over year. Now low, but continuing to fall from the peak of 54.2% in April. Remainder used car prices significantly boosted CPI inflations over the past few months. But let's look at the average age. So the average age of U.S. car and light trucks hit a record of 12.1 years. People are delaying, had to delay some of their turnover. They had to delay getting a new car. And this is creating some of this residual demand in the face of additional shortfalls and elevated prices. So the question is, how long can some of these vehicles last before they have to be replaced because they're either too expensive to fix or not worth fixing at all? And then when we look at the breakdown, so the average age of light vehicles in the U.S. So when we look at the total, that's 12.1, but cars is pushing towards 13 years with light trucks sitting at about 11.7. So this is all creating a additional drive for used cars, and people are trying to avoid paying up and letting some of this prices normalize, but it's going to be difficult to see what some of those price levels will be and how long you can wait, just given how we continue to reach a new record of the average age of light vehicles in the US, which is creating some of these additional problems of production straining against shortages, as we've talked about, and retail sales are starting to moderate. So we're starting to see a shift of, well, production straining against shortages, inventories at all-time lows, but retail sales are slowing. So realistically, we should start to see these continue to adjust, and it won't be some huge shot to the GDP because technically inventory drawdowns are bullish for GDP because you're going to replace it. But it's going to be this moderation between two, because as consumer sales come down, it'll kick into services, which will be supportive of GDP in the near term. But you're going to start to see some of this bifurcation between the two. And then this will help normalize CPI a bit. But again, because of the other two sides, it's going to remain elevated. All of this is creating a ton of volatility in the market. And the one that I want to touch on right now, because obviously the VIX exploded because the market actually had a sell-off, about 100 handles. We have now essentially taken back all of it on our ways to new all-time highs. So clearly there was no equity sell-off, but the bond volatility. So when we look at the MOVE index, which is bond volatility, measuring bond volatility, you can see that it kept dwindling in Q2. And what have I said about Q2? In the second quarter, QE outweighed Treasury issuance. Now we're on the other side of that. We had a fairly ugly two recent issues, with the 30-year and now the 20-year, and now we're seeing volatility tick back up. And look at how quickly it got to the highs from February, which is when I believe that the bond market ended, the bond bull market ended, and we were going to start seeing rates increase. Obviously, they have now come back down, but this is where we're continuing to say that this is going to continue to push higher at this point, and is going to put more pressure on the underlying and continue to shift higher. And this is when we start looking at 3, 10, 30-year auction bids. The Treasury auction bids from primary dealers, indirect bidders, and direct bidders have all flattened or declined over the past few months. So this is just highlighting that if we didn't have the Fed sitting there buying, there was going to be an underlying problem. And now as we move into July, into August, September, and beyond, this is only going to get worse. And it's also going to be under pressure because we're not seeing people come in and are just putting additional pressure on the overall market for treasuries, which is why, again, we continue to see rates going up. Now, rates have started to come back up, but they're not where they were even a month ago. So when you look at just where rates are, look at when we look at the 10-year, the 20-year, the 30-year, they're still at a shift down, but that's where we continue to see some of this coming up, and we expect to see some of these levels getting taken out again as pressure continues to mount over the coming few weeks. And this is just looking at on the break-even inflation side. So when we look at the inflation side of things, it's barely moved. And that all the while the generic government 10-year, which is just, when we're looking at what is happening in general, has come down, which is where we continue to see some of this residual that's going to pull it back up and come back to those highs on its way to 2%. And it's not just the 10-year. We talk about the 10-year because it's so important to the global market, because a lot of emerging markets price themselves off of the 10-year. But when we look at the U.S. break-even, the 10-year, the 30-year, the 5-year, the 2-year, all of these still remain at going back in time at highs. Now, while they've come off the highs, they're still now are starting to get pressured back to the upside, all because when we look at what the Fed continues to do. So what does the Fed continue to do? Well, it continues to issue $120 billion a month, even though we have now consistently over the last 7 days or so put about over $800 billion in the reverse repo system. So what does the reverse repo system do? The reverse repo purchases is just the Fed taking spare liquidity that the bank can't handle. So it essentially gives a nominal rate. It gives 5 basis points and will take in for up to 366 days as the longest of this out of the system, but it doesn't leave permanently. It always comes back in. Now, when we look to 2016, when we reached these, levels that were literally at 200 to 400 billion, there was a huge clamor to cut stimulus, to cut bond purchasing, and within 6 months it happened. We're now at a consistent over 800 billion. We're almost double what it was when everyone was clamoring to cut. And this is why, again, these setups, the liquidity, the amount of liquidity in the system is reaching levels of absurd. Then when we look at how is this filtering through the system? Well, let's look at PPI for final demand, 12-month percent change. When you look at just the total, goods, foods, again, foods have their own issue when we look at just the pressure on the market in general, considering just the shortfalls as we talk about droughts and floods. Again, this is just looking at the overall pricing pressures that remain in the system, continue to push through. And this, again, feeds down to, because this is showing you the cost that is going to get pushed into the CPI calculation, all pushing above the trend. So when we look at where we were coming into 2020, coming into 2019, because remember, I was bearish in 2019 as we started to see some of these pressures, and now we've exploded right back through that, and this is all filtering down into the underlying system. When we look at US PPI final demand, trade services for June up 2.07%, and when you look at just where we were, this is going back into 18, 19, 20, we're at seasonal highs. And then when we look at what is happening in general across consumer price index for all urban consumers, you can see just where it is at 4.5%. So then you want to say, well, let's use the trimmed one. Well, the trimmed one is getting pulled up now, and that's now back to the highs going back to 2016. And now when you look at the median consumer price index, it's already pivoted. So it's pivoted and it's starting to go up. And the problem is, as this pivots and turns, we're going to get an acceleration point on the consumer price index from the median side, because some point to that is like, well, look at that, and that's really slow. But again, looking at rent, services, all of these things are coming into this pivot point that's going to pick it up higher. And then when we look at relative core inflation points to a strong US dollar comeback, this is why, again, we've been saying our view is that the dollar lives at 92.60. It ran to 93. This is just kind of showing, I think, less about USD strength, but more about euro weakness. And that's going to be something to watch. I mean, it's going to inherently put a bid within the dollar, but I think it's just going to drain some of that liquidity and some of the people out of the euro into some of the other currencies as well. And rent of so this is just looking at rent in a different way, where you look at expect rent of shelter to follow home sale prices. This is just showing you kind of where things are over the next 3 to 4 quarters, which is again leading more to why this is not transitory. So then when we look at leading indicators for inflation are falling. So when we look at the 10-year break-even inflation, it started to come down, but we're starting to see that pick back up. And the core PC, again, is pushing to these highs. So this is where the core PC side, does it just go sideways, or do we continue to see this push up, and the 10-year break-even inflation is wrong? These are some of the things that we're kind of looking at to understand, are they both wrong, and they're going to continue to go up together? Because if you look at just where things are in general, when you look at core PC inflation, the commodity index has come down, but there's other inflationary factors, which is why we were talking about less continuous inflation, like not a continuous drive higher in inflation, but more of a stagnation to the sideways and a stagflation, because inflation is looking at month over month, quarter over quarter, year over year. So you need prices to keep going up month over month. But what if they don't keep going up, but stay elevated because they're being replaced by different things? And that's what we continue to see showing up more so than deflation, but really stagnation. And then when you look at just where rates are versus inflation, you can just see how absurdly low we are in relation to the 10-year versus historics, which is why we continue to come down to the 10-year being wrong and seeing some sort of reversion to the mean. And at the same time, we have another push higher in retail sales. So you had another push up in terms of dollar, it's in billions of dollars though. So when you consider U.S. retail sales control group in billions of dollars, you can buy less stuff as it's costing more. So even though the sales numbers are higher, it doesn't mean people were buying more stuff. They were just paying up for what they normally buy with some caveats within that. So these are some of those inherent problems that we continue to see in terms of where things are. Because obviously it exploded forward. You had huge transfer of payments for the government. So this is where we think you're going to start to see this roll over a bit and normalize in terms of just what people are willing to buy as some of these transfer payments slow. Now, one of the things that we've seen are some of the shifts in U.S. Empire State Manufacturing surveys. You had this bifurcation where the U.S. Empire or New York one was showing a big increase, and Philly a big decrease. But when you look at where the U.S. the U.S. Empire one was, it never really got to these high levels. So what we're seeing so far is that the Empire State is a bit overstated and the Philly one's a bit understated, but for different reasons. And this is when we start then look abroad and look at Caxton Market, Chinese PMI. Here you can see just where Empire State is and where China is, and how you're starting to get some of that disconnect, which we think will normalize as we go forward. But then when we look at U.S. Empire internals, number of employees are going up. That's a net positive for when, how they're looking to hire. And some of the delivery times have gotten better. Still elevated, but at least not at these dire straits that we've seen. But this is also looking at one segment of the U.S., as we've shown before in the first segment when we've talked about some of that global inflation, those global supply issues, and then a bit more of detail that we're going to go through in segment 4. Then when we look at prices paid, still at all-time highs, prices received still pushing higher, and prices expected to be received. So even though prices paid have flatlined, and this is, again, speaking to prices paid still kind of there, but prices received going up, prices received going back up. This is where we continue to see some of these problems to the underlying consumer. So then when we look at Fed manufacturing new orders, you can see that new orders have slowed, again, putting pressure because there's that issue on backlogs. Prices received have flatlined, prices paid have flatlined, and that's where we're starting to see some of this moderation. But on the import side, import prices month over month still remain strong. You're up 1% month over month. When we look year over year, up 11.2%. Exports month over month up 1.2%. Exports year over year up 16.8%. So month over month, we continue to see these prices getting passed through. Imports, we continue to import this inflation. We're trying to export some of this inflation. But again, the importation of inflation still remains very, very strong and continues to be an underlying problem. And this is looking at it a little bit differently, because when you look at rent is the one that we think is going to continue to drive higher. You can see how rents really come down. And as transportation diminishes, rent is going to pick that up and keep things elevated when you look at that switch on the what is going to be that driving force, keeping that stagflation in place. But all of this is also resulting in lower consumer sentiment, lower willingness to spend as wages remain under pressure and prices continue to rise, which is why when you look at consumer-based inflation expectations, they continue to push higher. People remain concerned on the underlying, but we are seeing that pivot out of durables into service sales, because people are like, look, how many times do you buy furniture? How many times do you buy a TV? How many times do you buy a car? But how many times do you buy, gasoline or food or, deodorant or, washing machine, dishwasher detergent, all of these things continue to drive higher. And you continue to see that, especially when you look at food services, all of this continues to go up and prices continue to go up as the consumption is rising, which is where when you look at U.S. retail sales recovery, you can look food services, a lot of these sales are still a bit low, but again, accelerating, keeping that bid behind a lot of these price increases. And this is just looking at U.S. retail sales adjusted for food and services, just to kind of look at that core side. But when we look forward at total card spending, you're seeing this card spending moderating. You're seeing some of these slowdowns on in-person. You have COVID-19 issues picking back up with Delta, the Delta variant. You're seeing some of these shifts. So you're starting to see some of this moderation. And then when you look at it in terms of, just online sales still remain high and are picking back up as, again, avoiding some of that exposure and avoiding some of the unnecessary risks. And this is starting to come back in where retail sales are just shifting again, and you're starting to see them slow down on a net level. So you're seeing some pickup in online, but you're still elevated in terms of retail sales in store, but net they're starting to come down as when you look at credit cards. People, the government transfers are abating. You're starting to see some of these slowdowns. And again, that's where we think retail sales will continue to cool, even though prices still have, or underlying prices still have this bid, which again is going to kind of, as the consumer rejects more, it's going to be tough to see these prices come down, just given what is in the pike, what is in the supply chain, which is where we're going to see this confrontation. So that's about the U.S. In the next segment, we're going to go more into India and Europe a bit to talk about, what are some of the issues that continue to arise on a global scale.